Silver did not just pull back. It got hit with a brutal air pocket. In a matter of weeks, the price went from a historic peak near $121 all the way down into the low 80s. And that single move has terrified late buyers, energized critics, and triggered one question across the entire metals market. Was that the top? Or was that the shakeout before the next major leg higher? Because make no mistake, what just happened was violent. This was not a quiet correction. This was not a harmless dip. This was the kind of move that makes weak hands dump positions, makes headlines turn negative overnight, and makes people forget the bigger story. But that bigger story is exactly where this gets interesting. Right now, the crowd is staring at the crash. I want you to stare at what caused the rally in the first place, and more importantly, what still has not gone away. Silver exploded into January, ripped to levels almost nobody thought possible that fast, and then got slammed back down. From roughly $121 at the peak to around $82 at the lows, that is a collapse severe enough to make people think the whole move was fake. Severe enough to make people call it a bubble. Severe enough to make nervous holders ask whether the bull market just died in front of them. That is the emotional version of the story. The structural version is much more important. As of now, even after this collapse, silver is still massively higher than it was a year ago. The metal has not erased its annual gains. It has not gone back to where this move started. It has not unwound the broader repricing that brought it here. It simply went from euphoric to frightened very fast. And when a market does that, you have to separate two things immediately: price shock and thesis destruction. They are not the same thing. A market can crash hard without the long-term reason for owning it being broken. That distinction is everything here. Because if the case for silver was only retail hype, then yes, the story would already be over. If this was just momentum traders chasing green candles, then the breakdown from $121 would be the obituary. But if silver's move was tied to industrial demand, supply tightness, strategic importance, and government recognition of its role in the modern economy, then this may not be the end at all. It may be the reset that makes the next move possible. Look at what happened. Silver ran too far, too fast. The market got overheated. Expectations got stretched. Traders who bought late started thinking every day would look like the last one. Then the reversal came, and it came with zero mercy. That is how powerful markets punish emotional entries. They do not drift down politely. They trap, they squeeze, and they flush. But flushes alone do not invalidate a larger cycle. Here is what the noise is telling you right now. The rally was fake. The blow-off is over. Speculation has ended. Metals had their moment. Move on. What the underlying setup is telling you: demand is not disappearing. Supply is not suddenly abundant. The industrial case did not vanish because the chart turned red. And the strategic relevance of silver did not get canceled because traders got scared. That is the gap most people are missing. Silver is no longer just being discussed as a precious metal people hold for fear. It is increasingly tied to where the world is actually going. Energy systems, electrification, digital infrastructure, advanced manufacturing, high-performance hardware, strategic supply chains. These are not tiny niche themes anymore. These are trillion-dollar priorities, and silver sits in the middle of more of them than most people realize. Start with the most obvious driver: solar. Every major push toward renewable expansion creates another silent drain on silver. Every build-out sounds abstract when politicians talk about it. It becomes very concrete when you realize that panel manufacturing consumes real metal. Not theoretical metal, not paper metal, actual silver. And as deployment keeps scaling, that demand does not care whether traders are bullish this week or bearish next week. Factories consume what they need. Now add the technology shift within solar itself. It is not only that more solar capacity is being installed, it is that newer cell designs can require more silver, not less, depending on the manufacturing path. So while the surface-level story sounds simple, the deeper story is more aggressive. More installations, more advanced cells, more metal intensity in critical segments. That is not a bearish setup for long-term consumption. Then move to the second force most people still underestimate: AI infrastructure. A lot of people hear artificial intelligence and immediately think software. They think models, chips, data, and cloud services floating in digital space. But AI at scale is physical. It is power-hungry. It is hardware-intensive. It requires huge data centers, dense electronics, energy delivery systems, cooling systems, interconnection systems, backup systems. and increasingly, renewable power commitments to support all of it. That means the AI boom is not separate from the metals story. It feeds into it. The largest tech players are racing to expand capacity. Those facilities do not run on slogans. They run on electricity and components. The electricity demand alone is staggering. The build-out behind it is even more important. When global data infrastructure grows, silver does not just show up indirectly through energy systems. It also appears inside the physical hardware ecosystem that makes those centers function. Now layer in the third major engine: electric vehicles. Every EV requires more silver than a traditional combustion vehicle. Not a little more, meaningfully more. That matters because unit growth compounds the effect. You do not need every car on Earth to become electric overnight for silver demand to matter. You just need millions more high-silver vehicles entering production year after year, while supply remains tight. That is the key. It is not one demand stream. It is multiple demand streams pulling on the same metal at the same time. Solar is pulling, AI infrastructure is pulling, EVs are pulling, electronics are pulling, grid upgrades are pulling, and all of this is happening in a market where silver supply is not easy to scale. That last part is crucial. A lot of people talk about mining as if producers can simply open a valve when prices rise. Silver does not work that neatly. Most of the world's silver output comes as a byproduct from mining other metals. That means a higher silver price does not automatically create a giant clean response in production. If silver is tied to lead, zinc, or copper economics in many operations, then the supply reaction is slower, messier, and less responsive than casual observers assume. So when people say, well, if silver gets expensive, miners will just flood the market, they are often talking about a fantasy version of the industry. Real mining takes time. Real production decisions are constrained. Real new supply is hard to accelerate. And when the market has already been running deficits for years, the idea that this all gets fixed quickly becomes even less believable. That is why the recent crash matters less to me than the supply-demand structure underneath it. Ask yourself this: did the collapse from $121 to the 80s suddenly create a massive new source of silver? No. Did it end the need for solar build-outs? No. Did it cancel data center expansion? No. Did it stop EV manufacturing? No. Did it erase the supply deficit? No. So what exactly changed? Price changed. Sentiment changed. Positioning changed. But the deeper pressures that helped launch the rally are still sitting there. And then there is the policy layer, which makes this even harder to dismiss. Silver is not being treated as some decorative legacy metal anymore. It has been elevated in importance because of where it sits in the modern industrial stack. Once governments start recognizing a material as strategically relevant, the conversation changes. It is no longer just about investor preference. It becomes about national planning, industrial resilience, and supply chain security. That matters because policy recognition tends to attract a different class of attention: bigger money, longer duration capital, corporate procurement awareness, strategic stockpiling discussions, changes in import and trade behavior. Those shifts do not show up immediately in a daily candle, but they alter the terrain. Now, none of this means silver cannot fall further. Let's be honest, it can. A market that just dropped that hard can absolutely stay unstable. Another washout is possible. Panic can overshoot. Volatility can get uglier. If macro conditions turn hostile, if the dollar strengthens further, if rates stay tighter than expected, if broad risk markets wobble, silver can get hit again. That is part of this metal's personality. It is never a gentle asset. It is emotional, fast, and often cruel. That is why anyone pretending this is a straight-line trade is not helping you. There are real risks here. The first is monetary policy. If the Fed stays tougher for longer, that can pressure metals. A stronger dollar, sticky inflation, or delayed rate relief can weigh on sentiment, even if the structural case remains intact. The second is China. China matters enormously across solar manufacturing, industrial flows, and broader commodity demand. If Chinese activity cools, if policy shifts, if trade frictions intensify, silver demand expectations can get repriced quickly. The third is efficiency pressure. Manufacturers are always trying to use less silver per unit. Sometimes that progress is slow. Sometimes it surprises the market. If silver thrifting accelerates faster than expected, the future demand curve can flatten more than bulls want to admit. The fourth is psychological damage. This one gets ignored far too often. A crash of this size does something to people. It changes behavior. Retail buyers who got trapped near the top become hesitant. Future rallies face more skepticism. Selling pressure can persist longer simply because people are wounded, not because the thesis is dead. And the fifth is correlation risk. Silver may have its own story, but it does not trade in a vacuum. If gold weakens badly, silver often gets dragged harder. If macro stress hits commodities broadly, silver can become collateral damage even when its individual fundamentals look strong. That is why this moment is so important. You are not choosing between a perfect bull case and a perfect bear case. You are choosing whether this was a terminal top or a violent correction inside a still-living structural cycle. To answer that, you need to know what matters next. The first thing to watch is whether silver can hold the zone the market is now testing as support. If the price stabilizes, builds a floor, and starts absorbing sellers instead of accelerating lower, that matters. A base after a crash is a much healthier signal than a dead cat bounce that immediately fails. The second thing to watch is Fed language. Not just rate decisions, language, tone, forward guidance. Markets move when expectations move. If the path toward easier policy becomes clearer, metals get breathing room. The third thing to watch is institutional behavior around silver investment products. When larger pools of capital start stepping back in after a flush, that tells you the dip is being viewed as opportunity, not contamination. The fourth thing is the gold-silver relationship. If gold remains firm and silver begins regaining relative strength, that can reset the entire conversation quickly. In a market like this, relative performance matters. The fifth is trade policy and supply friction. Anything that further tightens physical availability can force the market to reprice faster than expected. The more strategic silver becomes, the more sensitive it is to policy shocks. And the sixth is Chinese export behavior and industrial controls. Subtle moves there can have outsized effects on the global physical market. Most casual traders never see those shifts until price reacts. So where does this leave you now? It leaves you in the most uncomfortable zone of any major move, after the thrill, after the crash, before the next verdict. This is the point where people make the biggest mistakes. Some will sell only because they are exhausted. Some will buy only because they want revenge on the market. Some will do neither, and instead drift in confusion while the next setup forms without them. You cannot afford to approach silver like that. You have to decide what game you are in. If you are trading momentum, then respect the volatility and respect your levels. If you are investing in a structural thesis, then ask a more important question. Has the reason for owning silver actually broken? Right now, the answer is not obvious enough for blind confidence, but it is also nowhere near broken enough for blind surrender. That is why this drop is so dangerous and so potentially important at the same time. Dangerous because emotionally it feels like proof of failure. Important because historically some of the best opportunities in strong but unstable markets appear exactly when price action looks the ugliest and the narrative turns hostile. That does not guarantee this is the bottom. It does mean writing the obituary too early could be a very expensive mistake. Because step back and look at the full picture. Silver hit an extraordinary peak. Then it suffered a savage correction. Yet even after that, it remains dramatically higher year over year. The major consumption engines are still in motion. Supply remains constrained. Strategic recognition remains in place. And the broader industrial story has not evaporated. That is not what a clean, broken market looks like. That looks more like a market trying to decide whether it just ended a mania or reset a trend. And if it is the second one, then the people who can think clearly during the panic are the ones who benefit most. This is where the next chapter gets written. Not when everyone feels comfortable. Not when every headline turns bullish again. Not when the move is obvious. Right here, in the uncertainty. So here is the real question. Was the drop from $121 to the low 80s the final collapse of a blow-off top? Or was it the flush that removed leverage, fear, and weak conviction before silver tries to climb again? And here is the second question that matters just as much. If the long-term story is still alive, how many people are going to hesitate so long that they miss the next move because they were too busy staring at the last crash? Think about that carefully. Because markets rarely reward comfort. They reward clarity. If you believe silver's case was only speculation, then this rebound zone is where you stay away. If you believe the metal is still backed by a multi-layered structural demand story and constrained supply, then this kind of fear becomes something else entirely. Not proof that it is over, proof that this market is still volatile enough to create outsized opportunities. That is why I am not interested in the shallow take that silver crashed, so it's done. That take is too lazy for what is actually happening. What matters is whether the thesis still has force. Solar still has force. AI infrastructure still has force. EV demand still has force. Supply constraints still have force. Strategic relevance still has force. And until those pillars truly crack, silver remains a market that can still shock people again. Maybe not in a straight line. Maybe not without more pain. Maybe not without another scare. But shock them again nonetheless. So do not confuse a brutal correction with automatic thesis death. Do not confuse fear with clarity. And do not let one savage move erase the bigger setup from your mind. The market just handed everyone a reality check. The people who survive this part are the ones who stop reacting emotionally and start watching what actually matters. Now I want your view. Where do you think silver ends 2026 after this collapse? Below $80? Back above $100? Or does it do something even crazier? And after seeing this drop, are you buying weakness here or waiting for one more flush lower? If this gave you real substance instead of recycled noise, subscribe now and stay close, because the next move in silver could catch a lot of people completely off guard.